And that's the same way I feel about Intel. Because I know I got some Intel bears out there
You
that
got
keep
some
saying they're gonna
haters
cut
on
the dividend.
Intel, man.
Oh man, I can go on right now, but we're gonna keep it cool because Intel they're still out there, looking like, what do they call it, the crime scene? They call their earnings report the crime scene. I'm gonna
Yeah.
remember this, guys. Don't worry, don't worry. Every dog
I hope
has
you're
his
right.
day.
Hi, and welcome to the Investing on a 9 to 5 podcast. I'm Paul.
And I'm Teddy. We are excited that you are joining our show, Investing on a 9 to 5, where we will talk about our investment journey, our current strategies, and learn about all kinds of investing related topics. But before we dive in, we are not financial advisors. We will not be held liable for any personal investing decisions or losses that you may occur in the market. This page is purely for entertainment purposes only. Welcome back to the Investing at 5 podcast. It is your boy, the Dividend Dog. We got Paul Options _ Legacy here tonight.
What's going on,
I hope
dog?
you guys had a wonderful weekend and even better Monday. The dog's doing good. Dog's doing well. Everything is, rolling pretty smooth. Can't complain on my end. Cannot complain. It's a little rainy over here in Georgia, but that's
it? We got
Yeah.
rainy. We got freezing snow here. We got the roads are pretty much shut down. They got a few people brave enough to venture out, but it's all ice and stuff out here. So we're on snow days.
That's when you were telling me. I was like, man, you guys got another snow day?
Yeah,
like, man, I want a snow day.
It's nice, dude. For work, it's nice. The kids tomorrow they have to go on their Chromebooks and do some schoolwork, but it's not like in class Zoom style stuff. But I'm straight snow day. I got a straight day off, so I needed it. I had a really bad sore throat Sunday night into Monday, so I needed that sleep.
Yeah,
and I'm still dealing
those
with
sore
sore
throats
throat
around
right
this
now.
year.
Well,
sore throats around this year are always like high.
My son's had strep twice.
Last week I was feeling the same way.
Yeah, you were feeling down. So sometimes it's just that sleep you need. You got to get that sleep on. And I had to feel better. My daughter's 8th birthday was on Friday, so we had her party on Sunday, and had a bunch of kids here. Yeah, it was nice. She was very excited, and so it was good. It was real good.
That's good. That's always good. Birthday parties are always fun because there's always cake.
We had
always cake.
We do cupcakes, and it's nice, the cupcakes, but lots of food, so.
Yes.
And you can tell I don't go hungry often, so.
No. Neither do I. I like to eat.
I'm doing the intermittent fasting right now. I've been doing that for almost 2 weeks.
I think Dave does that. I think Dave said he does some type of fasting out there.
I hit him up about some fasting suggestions. One of them that he does was he hits a Celsius every morning. So I've been trying to integrate a little Celsius action in my fasting. Tonight it's coffee. It's straight up coffee. You know what's funny is this is a cheap, like just a regular thermos kind of mug. I've got a Yeti, and the Yetis, man, they're no comparison to these. This thing is by the end of the podcast, this thing is gonna be lukewarm. And I had a Yeti I filled up with hot coffee once, and it lasted all day long. That stuff I don't know what kind of nuclear
Those Yetis
uranium
are BA,
is
man.
in that, but it's awesome.
No, Yetis are clutch. I like them. I used to have one back when I worked at Enterprise Rent-A-Car when I was in Michigan. I had a Yeti cup, and I had like stickers and stuff all over. I used to put my coffee in the morning, and then I lost it. So that was the last time I ever buying one of those $50 cups.
I'll send you. I got like 4 of them free for doing a camera demonstration. So they sent me like 2 big ones, and then they sent me 2 like tumbler size ones.
What?
I know, man. We didn't buy the cameras, but I kept the Yetis.
The podcast. After the podcast, we'll make a deal on getting the dog a Yeti.
Let's just send a copy of this to Yeti, and we'll tell them we'll feature them if they send us something. So,
hey, listen.
Brandon.
This message is brought to you by Yeti.
One of these days.
Keeps things warm.
Man. Awesome, so what are we talking about today, bro?
I mean, the market is like, it looks like it wants to make a rebound. It's trying to do something, but I'm like, also like,
this whole week is going to be like this.
Same time, I'm still new in the game, so I'm like, all right, do I want to push this bullish momentum?
What's kind of interesting is being new in the game is, I think this is the best time to get in. I mean, if you were in the last 10 years,
hands down.
Well, if you were in the last 10 years, then you experienced that whole rally. But if you got in like 2020, then maybe you were part of the crew, who made some of those gains on some COVID stocks, who maybe made some money on the meme stocks. But if you were
AMC,
just
GameStop
trying
boys
to,
out there.
right. Well, we know a lot of those guys are indicted as well. So, not the GameStop people, not like, not Deep Value and those guys, but like the Atlas Trading people. But if you were
Mm-hmm.
just a dividend investor, just trying to make some good picks and just trying to build a portfolio, it was a horrible time because the valuations were so high. You look at these stocks that you're buying now at 40 and 50% off their all time highs, you're getting in at a great time. So,
Yes.
I feel really good that, this is a time that I had the opportunity to really build a portfolio up of these I went through all that mess. I made a little bit of money on GME. I made some AMC money and some other companies, but I never went like big in where, I had like life changing money because I was just, I didn't want to
Right. Right.
put a portfolio in on it. At the same time, I lost money on some other crap that I could have sold at highs and I rode too long, so there was a learning curve for me this whole last, couple of years. And I think now is a good time to have settled down a little bit, to have a focus of the kinds of companies that we're looking at the same time, having a little money on the side to throw at something.
Right.
I got a few specs on the side that I throw into. I would talk to you about them offline. But it's not something I would promote to people because it's
Mm-hmm.
not something that, I want someone to lose money over, but it's good for you. I think you're in a perfect time.
Exactly. No. Nope. Yeah, and actually, what you said is about setting up the portfolio the right way is actually, one of the things I'll be talking about today with Fidelity and their zero fee funds. We were talking about
I
that,
need that. Yeah. I don't know anything about mutual funds. We'll talk
and
about when we
these
get there,
mutual,
but
yeah, we'll talk about it, and cost you $0 to own these things from what we'll be talking about. But back to the market, you know, I mean, I'm gonna say we're gonna head towards like a bullish, bullish area. A lot of my plays right now are, they're up,
mm-hmm.
10%, 15%. I'm up 21% on ET, 20% on Comcast.
Right.
The only one I'm losing in right now is Kroger, and I'm down like 4% on that one.
Ooh,
But
that's your
I'm not,
dividend right there, though. Your dividend will cover that.
yeah, I'm not. Yeah, and I'm not something I'm worried about. I actually just got back from Kroger. The girl,
There you go.
get
Pay
just with
into
the
it.
whole did the whole transaction, so I know they're not going anywhere.
I'm
Um,
I'm gonna I'm gonna be I'm a little more bearish than you. I think some of the people I
okay,
read are a little bit more on the bear side with specific companies. As
yeah,
a market on the whole, I think this year is going to be kind of a corrective phase. I don't know if we have a huge like 20%, 30% drop coming. Like some people were thinking the SPY is going to drop back down, or not SPY, but SPX is going to come back down to the 3,200 range. It could. I don't have that kind of insight in macroeconomics,
right,
but just a lot of the people that I've learned to read over the last few years, they've gone from being very bullish on specific companies to having more of a bullish, a bearish lean, but they're still finding companies that are positive and showing growth.
yeah, yep. You got the positive growth coming in.
So we'll see what happens. I think this week is going to be a sideways week. I think we're going to see people not quite sure if they're going to, go risk on or risk off until after the FOMC meeting. And my prediction is FOMC comes in at 25 basis points and they continue kind of the same rhetoric that they've been trying to do. Using their words to try to keep the market from rallying as much as they're using their mechanics of raising rates. So I think we're going to see kind of the same. I think we're going to see days of rallies, up 5 to 6%, and then we're going to see some drawbacks. We're going to have 5 or 6 days of green, and then we're going to have 1 or 2 days of red, and it's just going to be a sideways tug of war for a few
Yes,
months, is what I'm thinking.
I was looking at the market last week, and I noticed, I was like, I wonder why we didn't have like a full. We haven't had like a full week of it was just
No,
all just strictly green. Like you mentioned, you would have those couple of days where you're like, boom, everything's green, and then the last couple of days, like you said, it'll be red.
that's
Or
right.
obviously, the market is having its, we'll have some sell days or whatever. But that went out. That goes back out to my tweet. What I tweeted out earlier this morning is that don't be afraid to take a stab at these red days,
No, this one you got to be
especially
buying. Those are the days you got to be
this.
buying.
And this time here is going to really show. For listeners out there, like who's been doing their homework. Are we really reading the headlines or are we reading the balance sheet?
No,
You know, the,
it's
those are
it's
those are two different types of things that we have to be second level investors right now.
I don't
You
think
know,
anyone has to be worried that on the majority of stocks that we look at, there's going to be a few that are just going to start running and you're going to miss the boat on. But those aren't companies you really want to be in. You don't want to be invested in those companies anyway because they're running for some short squeeze reason or they're running for some other inflated reason. But if you're looking at, the run of the mill companies like or Intel or Walgreens, Amgen, those kinds of companies,
CVS,
right? Those blue chip companies. Then you buy some on the red days and you ride out the green days, and it's going to come back down. It may come down to where you bought last time. It may come down a little bit lower, a little bit higher. But the hardest part for me is trying to decide how much money I'm going to hold back, how much dry powder do I want to keep stashed, and how much do I want to deploy on these red days? Because I still want to have some for the next red day. And I want to have some for the next company that falls into my purview that I decide I want to add to the portfolio. So that's where I think we really got to have some. You really got to think to yourself of what your risk tolerance is, what your portfolio size is going to be as far as numbers of companies, and just kind of do some math and figure, okay, if I want 50 companies at 2% weighted each, then you know how much money you got to put in each company, so you know how much to keep on the side. And then maybe you do like what a lot of people I see on Twitter are doing. They're doing $10 a day, $25 a day. They're just doing those little set dollar amounts until they get to the point where they're in a full position. And then you start looking at another company and trying to do the same thing. But that's the toughest part. That's the discipline that comes into it. And if you decide you want to be a disciplined investor, then dividend investor, then discipline is the key.
Yes, dividend investing, like you said, discipline is the key, and obviously patience too. Patience pays in the dividend game in long-term investing. Patience pays. But you mentioned, by adding $25, $50 here until you have a full position. Now, I've done that strategy before. I did that all last year. I invested every single week last year. I remember
it was a good year to do it.
Yeah, last year I invested every single week. I did not take a week off from investing, and I'm gonna say like it will help you as an investor long term because it will hold you accountable that you have to do this every single week or every biweekly when you get paid. Or some guys they do $5. There's one of the guys I follow. He does $5 a day into SCHD, and that's totally. And guess what? He does it every single day like it's clockwork.
Right.
And that's awesome because at the end of the day, long term, you're gonna have that full position. You're still gonna get the gains. It just may take you a longer time period, but you're in the game.
Right.
And
you're not going to stress that you bought your full position at $95 a share and all of a sudden it's at 90 and you're $5 below. Well, so that's why you hold some back. You buy some at 95, some at 94, some at 90, some at 95 again, some at 93. And then at the course of the year, you averaged out pretty flat. That's one of the things I like about M1 and the two portfolios I have with M1. Each one gets $25 a week. And I don't ever see I'm not looking at a bid ask spread. I'm not looking at a limit or a market order. It just does it. There's pros and cons to the way they execute orders for you, as far as what kind of control you have over something. But it is very good for that. It's very good just for putting some money to work on a weekly basis, and where you're not worrying or stressing about how much you're paying for that company at that time, because they're all companies that I'm holding long term, and so I don't really care.
No matter if you have the conviction that you want to hold this stock or a company, you have to tell yourself up front that I'm going to hold this long term and I'm going to continue to buy this.
Absolutely.
No matter what. Absolutely. And that's the same way I feel about Intel. Because I know I got some Intel bears out there
that keep saying they're going to cut the dividend. Man.
Oh, man, I can go on right now, but we're going to keep it cool because Intel, they're still out there, looking like, what do they call it, the crime scene? They call their earnings report the crime scene. I'm going to remember this, guys. Don't worry. Don't worry. Every dog has his day. Listen, this is my take on Intel, right? So they're building the chip factory here, guys. Like, yeah, I understand that AMD and TSM, they have all of that, but we're focusing on we have to go across the water every time to get chips, right? We got to deal with all of that
Oh yeah,
all the
the uncertainty
fighting,
in
all the
China. Yeah.
tension, every single time. Every single time there's tension. Every time we talk about semiconductors, we always talk about tension. You can't say the two without each other.
No.
When Intel brings those chips here in America, what do you think that's gonna like give some companies like, hey, I don't feel like I have the risk to go over to TSM. But even though TSM are building chip plants here, but Intel has the longevity to do it, guys.
Yeah, it's the security of the product.
Yes, and the CEO just put $6 million of his money in the stock.
Good sign. Always a good sign.
So ask yourself this, listeners: if a man puts $6 million into anything, do you think he's about to lose money on it, or is he about to make some money in a couple years? And I'm gonna rest my case.
You're right. Political aspirations excluded.
If we're gonna put some money on the table, that man just put $6 million in the company, while you guys call his earnings a crime scene.
And he knows the company better than anyone. He knows the company better than anyone. He knows the plan for the dividend better than anyone.
And he's mentioned it 3 times that they plan on not cutting the dividend. But everyone likes to read the headlines. That's fine. You guys read the headlines, I'll buy it. There's 2 difference. Yeah. So yeah, that's what I've been doing all week. Is I've been loading up on Intel. We're up 20 shares now, and we're still up like 3%. Even though that whatever drop happened, that's totally fine. It gave me more. They gave me more opportunity. Gives us more opportunity to buy.
Right.
Their 2024, 2025 chips are going to be bouncing back. So, I like right now. Yes, Intel does not look good, but 2025 and forward, that's when I think we're going to start seeing some traction with the stock.
And that's the way you've got to think when at your age and other people who are in your generation, because that's what you have to look. You cannot be looking 1 or 2 quarters in the future, worried about, what's going to happen to the stock price. You got to be thinking, I'm holding it now so that 5 years from now, that money is going to be staring back at me.
And they pay the best. Exactly. And they pay the best dividend and that's what we are. I'm a dividend investor. So yeah, I'm going to go get that 6% yield. It's not going to grow. That's totally fine. That's totally fine. I got
and it gives you somebody to argue with on Twitter about.
Yeah. You see those guys, they get me going sometimes. I'm like, listen here, guys. Listen here. I do my research. But one more thing before I swing it over to you, Paul. China is starting to rebound. The reopening over there is happening.
Yep. They did their change of their policy for COVID, so they're a lot more security.
Yes. Yes. So Neo will be, is already set up in perfect position over there. But that's what I've been paying attention to, is that like how the Chinese market is gonna be rebounding here, because they're the number 1 oil consumer in the world, aren't they? Over there in China.
Yeah.
Yeah. So like ET, Chevron, like those guys are. I know they're hungry for for them to open up over in China too, especially manufacturing, all the services that they offer. I mean, there's a lot that goes on over there.
Are you an ENPH person?
ENPH? No. That sounds
it's an
like
energy. I don't think it's got any. I don't think it's a dividend pair, but it's an energy stock. And I was noted it's had a good run last good since like August.
I see that.
Let me see.
Wow.
I don't think it's a dividend payer, but some people I've been following, listen to. No dividend. But they're thinking that it's getting close to a bottoming point, a buy point. So any y'all out there who are interested in the energy sector in general, not a dividend payer, but ENPH is one you might want to take a look at just for the chart. What the chart looks like. I'm not in it. I'm not planning on buying any, but since you brought up energy, I thought I'd throw it out there. I just read.
Yes, this is good. Yeah, this is awesome. I'm gonna follow this one. I like following companies just because you never know what you can find out there, guys, by following a big company like this and what other companies that are like similar to this one here. And you can always find different stocks that no one's ever heard of, and make you some cash out there doing a little research.
Yep.
Awesome. So Paul, you got Dogs of the Dow.
Yeah, I
It's
figured.
on the chopping block.
Yeah.
Go ahead.
So this is one I started at the beginning of the year. So real quick, the Dogs of the Dow strategy, I think it's been around for a while, and it hasn't done too incredibly well because the whole idea of the Dogs of the Dow is you take the 10 highest yielding Dow component stocks. As most of us know, generally, if a stock is yielding a high dividend, then that's because the price per share is down, which could indicate some trouble in the company, or some other factors at play that may be a negative tailwind. So there's some risk involved in that. I would imagine that GE for a number of years was probably on the Dogs of the Dow list, and we all know what happened to GE after they got delisted from the Dow. So there's a caveat to that. So, and also it may not have done too well because in general, the Dow hasn't been like it's 30 companies. It's not a wide swath of the market like the S&P 500 is. It's very sector specific with industrials and a few oil and medical companies and some chip companies. So it really doesn't have that kind of diversification. But I figured this year I would try it. I had some capital that I could deploy into the strategy. So the third, January 3rd was it? That was our first trading day of the year. I went ahead and I in a Schwab account, because through Schwab slices you can buy a one lump sum and split it up over a number of stocks, as long as you put a minimum of $5 in each stock. So I went into the Schwab slices program with $1,000, divided it evenly up among the Dogs of the Dow. And I'm going to share the screen right now about what is for all y'all who are wondering about last week is we had recorded a podcast and we did the video recording, but part of the video, the old dividend dog shared his portfolio screen and inadvertently shared all of his account numbers. So we opted to not publish that.
Yeah, you guys don't want that.
So this is a shot of my.
You guys can't be taking all my dividends.
This is a screenshot of my Schwab account. There's no account numbers in there, but this is what it looks like when you log into Schwab.com. So this looked a lot better on Friday when I shared my Twitter update, but today was kind of a rough day for the Dow. So here we are. It's sorted by total percent gain. So for our non-video listeners, we have Dow Inc. DOW. We have Intel INTC, JP Morgan JPM. We have Verizon VZ. We have Cisco Systems CSCO. We have Chevron at CVX. We have Walgreen Boots Alliance at WBA. Amgen Incorporated AMGN. IBM at IBM, and 3M at MMM. Now, 3M, an embattled company, looking at some potential liabilities with some lawsuits that could range into the billions. So there's a reason that 3M is on the screen here. We've talked about Intel and why it's here, and these were all kind of set at the beginning of the year. So these were at the highest yielding at the beginning of the year. They continue into the month being the highest yielding stocks. So you can see here's the symbol and the company name, and then in the quantity section, and then at my cost basis, and then their current price. So I have about $100 in each one. You can see right here, there's $100 went into each one. For some reason, Cisco got $100.80, and other companies got $99.99. That's just Schwab's computer system. But so far, overall, I am up 1.2% on the portfolio. So I'm up $11 on the portfolio. The company with the greatest gain so far is Dow Inc., which is up 14.28%. The greatest loss right now is 3M, which is down 7%. In between, we've got Intel at 4.3% up, JP Morgan at 3.56% up, Verizon is 3.45% up, and Cisco is 1.23% up. Bringing in the red zone, we've got Chevron down 0.54%, Walgreen Boots down 1.47%, Amgen down 3.19%, and IBM 3.99%, and then 3M. So overall, I can't be mad at this. Oh, you know what? You know why Cisco's at 180? I just got a dividend.
Why?
They just paid an 80-cent dividend. So
Ah,
I reinvested that. So that's why
there we
I just
go.
remembered it. So it's got $100.80 because I got an 80-cent dividend on my 2.1162 shares. That just got paid out on Thursday or Friday last week. So I've
Okay.
got you can see in this column here under reinvest the dividends, they are all marked yes. So throughout this
Yep.
next year, I will reinvest all the dividends as they come into that company. We'll see how it does. I mean, historically, this is like a 3 to 5% gainer over a course of a year. There are offshoots to the strategy. There's the small dogs of the Dow, which takes the top 5 yielders. And if you go to dogsofthedow.com, they promote a similar strategy called the Dogs of the Dow X, which I believe is the top 3 Dow gainers or Dow yields. And they claim that the Dogs of the Dow X has returned like 10% a year. So maybe next year we'll try that one out. But this year we're starting with the regular Dogs of the Dow, and that's where we are. I'm up $11. I can buy a couple of Starbucks with that.
Heck yeah, there we go. Those dogs are the Dow. I mean, I love the list. Those are all great companies to be in singly or within an ETF. So,
and that's my challenge is going to
that
be
is.
is next year. Am I going to just um, I don't know how I'm going to manage it. I have to decide if I'm going to sell out all of them and buy all back at the beginning of the year, because some are definitely going to, some may fall off and some are going to be repeat offenders. So we'll talk about that. And if anyone out there has done this strategy or has any ideas when we go through these different ideas, throw it out to us. Hit us up on Twitter. Let us know if you do the
Yes.
strategy, if you something you've tried in the past, or if you have other ideas. And what I was thinking, dog, and we hadn't had a chance to talk about this yet, but it'd be fun to do a
Yeah, go ahead.
similar. It'd be fun to do a similar one with REITs. I was thinking about like breaking the REITs up into
Ooh.
different sectors, and then maybe taking like the top 2 out of each sector, and
Okay.
maybe go through some of our other criteria, because REITs are kind of weird, but go through some of our other criteria for dividend paying REITs. But look at free cash flow, look at
AFFO.
dividend payout, yeah, and then maybe develop like a top 10 REIT list. I think that'd be fun to do.
I'm into that. Yeah, I'm into that.
And I know you got your
I
friend Brad.
am.
You and your buddy Brad. He might be able to help us out with that.
Shout out to Brad Thomas out there. That man
He
is the
probably
goat
already
in
has
real
one. He
estate.
probably already has a book or something on that. So, well, let's hit him up. Let's talk to him about that.
Yeah, he definitely has a book out there. We'll have to hit him up on it and see if he can come on and talk some real estate
That'd
on
be
the
fun.
podcast.
That'd be fun.
For sure. Yeah, no,
So
that would be. So yeah, we can. I'm into it. I love REITs. So
yeah, I was thinking about the other day. I was
I
going to call you, but
can.
I think it was late, and I didn't want to bother you. But it hit me, and I'm like, oh man, let's.
Oh no, give me a ring. I pick up.
So anyway, my throat's starting to kind of hit me a little bit. If you don't mind taking over, I'm gonna. This is bad.
Oh yeah, I got you. Cool. So I'm gonna go ahead and take us here to the lead us here to the promised land with the Fidelity zero fee funds.
I'm
So
glad you're doing
guys,
this because
yes,
I started my 403b, excuse me, and
you're good.
I had a company. So in my job, there was a person who was managing like these retirement accounts for other people in where I work. And when I started looking at it, the 403b with Fidelity, it's only mutual funds. You can't invest in individual securities in that retirement account. So I went ahead and went with this company. And then I don't know if I told you what happened was something technical happened with the way that their accounts were managed. They used to be able to go in straight to my Fidelity and just make buys and sells and take care of it for me, but they changed RAAs and they weren't able to do that anymore. So what my advisor came back and said basically is we will continue to feed you recommendations, what we would normally do for your account, but you're gonna have to go in and do your own mechanics inside your account. We're not going to charge you anymore. So you're basically getting all of our services as far as recommendations go and management for free until we can get things settled up back with Fidelity. So I showed you that list that he sent me originally, that list, and I was like, man, these are like $50 commissions on these funds. They had like 7 on there. I'm like, I'm not spending $300 to, And I hit him back, and he's like, "Oh yeah. Thanks for letting me know. Here's the list of Fidelity funds that we're advising." So I think I shot it to you. It was like 3 no commission funds, and that made a huge difference, man. $300.
Yeah, see, save $300 right there just because someone else is doing the work that you could easily be doing yourself. Right. You know what I'm saying? Not just to you, but for any listeners out there with your 401ks, guys, go and take a look and see the expense ratios of how much they are charging you to own to have your money. That's your money.
I will tell you right now, if you go look at, if anyone out there has a target date fund, then you are getting screwed in expense fees. Target date funds, not only are they way too conservative, even on the aggressive side, for my opinion, my opinion only, but you are also paying out the yin yang on expense fees for a target date fund when you could go buy you can buy some bond funds, you can buy the VOO or VTI, get the same exposure you would in that target date fund with half or more in savings of expense fees. I'll get off my soapbox now, but the expense fees with those funds are out of there. And I didn't even think about it with the mutual funds. I had no idea, so I don't know what loads are. I didn't know the commissions were so high. I don't know how a lot of that stuff works. So that's why I was willing to hand it off to someone else to manage for me. The dog here has been amazing at helping me navigate the fund pages and identify the fees and stuff. So it's been awesome on there.
I got you.
This is the hidden stuff, man. When you're only doing $5, $10, $25 a week, you don't want 1% of that going off every year into fees and expenses. That's just money flushed down somebody else's
pocket.
Yeah. When a few extra minutes of research, it is. A few extra minutes of research is going to help you avoid those fees. So, okay, rant over. Sorry.
Or you can listen to our podcast. Therefore, you can just listen and get all the information for free.
Well, you can get the information, but we're not going to tell you what to buy.
Oh, no. Oh, yes, exactly. This is not financial advice again. But we're going to jump over and talk about the 4 funds. So Fidelity has these 0 fee funds. So that means that costs us, the investors, nothing to own. Now, here is the catch. There is always a catch. Here is the catch. The catch is that they hope that they keep you here within Fidelity because it's free to use the platform. It's free to buy these purchases. Well, it's not free to buy them, but it's free for you to manage and own it. But they are hoping that you will later on down the line hop into something else hop into another one of their products down the line that they will get revenue from you there that you may need.
You'll open a brokerage down the line, get some insurance or something.
Yes, yeah. They have a higher percentage of people. This is all laid out stats. They already know they have a higher percentage of people that are already doing that. So
that's the same way Robinhood offered 1% on their IRA. So they get you in the platform, you get used to it, and you stick around. And it's such a pain in the ass to switch brokerages.
It is annoying to do all the switching. So Fidelity, guys, this is not a recommendation, but I use them for rollover IRA. I have a brokerage with them. So within my IRA, I have my 0 funds here. So what they do is they just another ETF mutual fund or index fund is what they're called. And they track a certain sector of the market. So there's 4 of them once again. So you got FZROX. So VZROX is what I call it. This one is the total stock market index. So what that means, it tracks when you purchase this index fund, you are purchasing the entire stock market. So you get 2,817 holdings in this in this index fund, and the top 10 holdings: Apple, Microsoft, Amazon, Berkshire Hathaway, Google, United Healthcare, Google, Johnson Johnson, ExxonMobil, and JP Morgan Chase. So you're once again spread out within everything. So you purchase the entire stock market with this one here, and there's only a 3% turnover rate, meaning that they've only turned it over and changed out the portfolio like 3% of the time. So that means they don't change it out very often. So whatever they have set in here has been working very, very successfully. And since 2000 and 19, if you were to hypothetically were to put $10,000 into this fund, by now with dividends, total returns, you would have had $14,000. And and like the other sectors that it was tracking, we would have had 13,000. So it's outperformed the larger blend stocks. Year to date, it's at 6.67% return. The past year, it's down 19%. Past 3 years, 7%. Its past lifetime is only up 8%. 5 years, it hasn't had that much time to do that much work for 5 years. But it's got a 3-star rating here on Fidelity, Morningstar rating. It's given average returns and very low expenses. So you got FZROX. I call it VROX.
What is the expense ratio on that?
It is 0.00. Oh, these are all 0.00 expense ratios. These are all zero funds. So it costs you nothing to own this one here and nothing minimum wise to invest. Normally, index funds, guys, you would need like at least $1,000 minimum to get in some of these index funds on Fidelity or Vanguard. But they have, like I said, they have these here just for investors, 9-to-5ers, just like us. And this stock is only right now, it is at, let's see, I want to give me the price. It's at $12.64. I think that's what it is. Let's see. Fidelity wouldn't give me the price. It was only giving me the target price range. It's actually right now, guys, $14.05. Yeah, $14.05.
Okay.
Right now. And actually, I was purchasing this one here, Paul, around I got in at like $12. So it's up it's up pretty solid here in the Roth. And then let's see, the next one here is FZILX. Now this one is the Fidelity Zero Large Cap Index Fund. Ticker symbol, I'm gonna say it again for you guys, FNILX. Once again, zero expense ratio fee, doesn't cost you anything to own this one. Now, this one here, tracks just large cap. So you'll be large cap stocks, so $1 billion companies. Once again, so it'll be more likely Apple, Microsoft, Amazon, Berkshire Hathaway, Google, United Healthcare or United Healthcare, Johnson Johnson, ExxonMobil, and JP Morgan Chase. So basically, Paul, same type of setup as the other one, FZROX. This one here just tracks just larger capping stocks, and FZROX, it was more so give you the entire stock market,
Yeah, I see that the FZROX has 2,800 holdings, and this one has about 509. Mm-hmm. So you're more concentrated. I can see that.
509. Yep. So it's concentrated down. And this one here has another low turnover rate, 3%. I mean, that the lineup that they have here with the holdings, they don't change them out very often. So that's good to see when you're looking, at an index fund. And this one's up, year to date, 6%. The last 3 years, 7.36. Last year, 19%. So they're all performing the same with each other. They kind of go hand in hand, FZROX and FNILX here.
Now, what do you do? I'm looking at them right now, and
yeah,
what's the equivalent to judging their dividend yield? Is it the same? Is it that is it the distribution history? Is that consistent, or is that change for the mutual funds?
That's a good question. Let's see. Let's take a look here.
So I'm looking at them side by side, and their dividend history is pretty much the same, but I'm not seeing a yield. If they do a general yield like we do with dividend stocks. And this is my education. If I was trying to compare the two.
Oh, no. I know FZROX has a dividend yield. Hold on. It's 1.15 for FZROX. That's what it's saying here on Stock Rover. Let me see what it's got for. FNILX. Okay. So this one has a dividend yield of 1.4%.
Okay.
FNILX. And then FZROX has a 1.52. So it looks like they're about the same, actually. But let me see who's raised if anyone's raised the dividend. No. So I'm actually looking at the calendar year dividend payments now, Paul. And 2019 for, let's see. For Xerox or FZROX was 17.17, then it jumped up to 21.21. So it looks like they've been increasing the dividend since 19. And then for FNI, the large cap, they've been increasing the dividend too since 2019. It started at 13 cents, now it's at 20 cents. So those are pretty big jumps there. Now, the next one that I have is the International Index Fund, FZILX. It's another zero fund, 3-star. Now, this one specifically is going to tackle just all international. So you'll get your Nestle, Taiwan Semiconductor, you'll get Samsung, you'll get ASML Holdings, you get Shell, you get Roche Holding. Let's see. Dividend yield is at 2.5% for this fund. The past 3 years, it's up 12%. Past year, it's only down 3.6%. So that looks like that's pretty solid there for international index fund. I was reading some of the international stocks. The international market may be a place to take a look at for some exposure.
Yeah.
So this would be a good one to add to the list too. And this is a $10.62 index fund here, guys, that Fidelity's offering once again. It costs you $0 to own, and it's got proven, the proven history behind it, with returns.
This is really great information because I had no idea how the mutual funds worked. So just having this background to see how to compare them and what the key characteristics to understand are, is huge.
Of course, no. This is awesome. Once again, I'm still learning too, so I don't have all of these in my portfolio. I only got FZROX and FXAIX, which is the S&P 500 fund from Fidelity, but that one comes with a low expense ratio, which is like 0.00 or 0.006.
Do their dividends normally get paid out once a year? Is that how the mutual funds work?
Or they I think it's at the end of the year too.
Yeah.
No, it's quarterly. It's every quarter, but you do get one at the end of the year though, because I remember my Fidelity ones were coming in at the end of the year. So yeah, they get them every quarter.
Awesome.
So what I like about the last one here is FZIPX. It's the extended market. So this is like mid to small cap US companies, guys. So companies you probably never heard of that are just on the roll to be like the next Apple, the next Google. Not saying that this is gonna turn it into that, but this is how we have to think about the extended market index. And by having all 4 of these funds, guys, will completely diversify you into the stock market worldwide, I think. Then you can throw in some REITs if you want to do that too. Not financial advice. But these 4 funds here should definitely be keys to driving you to financial, down the financial path you want to go on. I'll stamp that. These 4 funds here will help you out, especially for new investors. So this zero extended market fund has a 1.5 yield. So I'm looking, it looks like they all have 1.5 percent yields, like these like index funds from what I'm looking. Even FXAIX has the same type of dividend yield. But this one here, guys, will put you in companies, like I said, small and mid cap. So what we got within this company, you got LPL Financial Holdings. I have no idea who they are. I know who Still Dynamics is. I know who Rivian Automotive is. First Solar is a solar energy company. We just got done talking about an energy company. You got Royalty Pharma, Texas Pacific Land. You got Bungie Ltd, Iron Mountain. They get talked about a lot in the dividend community. EQT Corp and WR Berkeley Corp. So once again, these are small mid cap companies that a lot of you guys probably never heard of. I haven't heard of a lot of them. If you have, that's awesome. But this is just another, like I said, index fund that will help diversify you into a different market that's developing and it's on its way. The last 3-year dividend changes for this index fund was 10%. The last year is at 7.5%. So looks like they've been, increasing the dividend within the index fund. Now, one thing too I like about Fidelity's like strategies and the way their platform is set up too is they show you the fund managers who manages these funds, which is also very important to know who's managing your funds too. When you guys are doing your research on index funds or your 401ks, it's always important to know your expense fees and know where you're investing and know who's managing that money. So they have a group here. What I like is, they've been managing these funds since 2018. And this same group, they'll give you a history on what they previously have owned. So this group has owned the FXAIX before, small, mid cap. They've owned some of the other funds that were talked about, like the Zero International Fund, the group that owns the large cap one here. They've once before they've done the international fund. So they go, you can see like their history on what they've owned and their total returns, and it goes a long way when you're investing.
Right.
So these funds here are very, very, I think, are key. They should be in everyone's portfolio. I think at least one of them, at least the total stock market or the large cap. Because I mean that gives you everything, and you don't have to pay anything to own it. Only you do is just put your $10 in. I mean, if you're looking at it, I'm like, all right, cool, $100, give me 10 shares a week. I'm knocking that out, and then I'm gonna get another 100 shares. You know what I'm saying?
Right.
Or like $10 a week or $20 a week. These, you can easily rack up a lot of shares with this.
I definitely don't think you can go wrong with a total stock market and then some international exposure, or an international with a small, mid, and large cap fund. Those are just some real easy guidelines that anyone can use. Anyone can go on to Fidelity or Schwab or TD, your preferred brokerage, look up ETFs and mutual funds and search for, large cap, mid cap, small cap, international. And then, do some quick searches and you can find your expense ratios are down. You can find your dividend histories and make a pretty educated guess just based on some parameters like that, because these platforms will also guide you to their no loads and no expense funds. So if you're on Fidelity, you can find the Fidelity one that will fill those boxes. And because the underlying stocks are all kind of the same, whether you're buying SPY or the Fidelity no load, total market fund, you're holding the same companies. What you're doing is SPY is a very expensive ETF to own. That's why it's a trading fund as opposed to people that hold long term. But you can go into one of these funds and own for a much, much, much lower expense ratio and still enjoy the gains the stock market's providing over the years.
Yep, and you get a chance to be at the same party as everybody else.
Yep. Awesome, man. Thank you. That's good information.
Yeah,
you've been very helpful for me with mutual funds and the whole thing since I've had to force myself into learning about them.
No, you're welcome. And this is all new for me. I'm a forever student to the game, so I'm always learning and itching to give back, especially to you, because We're rolling strong here on the podcast.
That's right, man.
Heck yeah. But yeah, that's all that those are my four topics or four like stocks that I wanted to bring up to you guys, cuz I know we kept talking, I kept talking about like the individuals, and I know the risks associated with a lot of the individual plays. So showing more exposure with ETFs and index funds for you guys out there will take you a long way. You will beat any individual stock picker by
Man,
picking these ETFs.
if you're someone who doesn't want to sit there and watch a screen and do like this deep dive research that you really need to be able to do on individual stocks, if you don't want to do that on a weekly or monthly basis, then you really can't go wrong with a low cost index fund. And there's tons out there, depending on what part of the market you want to get. Vanguard is the OG of ETFs, and they have very, very low expense ratios, and you can find a fund within that family that covers every part of the stock market. And then, as you get more comfortable with it, and as you start collecting dividends, then if you want to go buy an individual, then that's no problem. But you'll open those funds up and look at their holdings, and you'll see that any company that you'd want to own is there. Apple, Microsoft, Tesla, Intel, AT&T, Comcast, whatever. I know on Schwab, actually I think on Schwab, I won't say I know, but I think on Schwab and on most brokerages, you can search by stock what funds hold it, or like the top 10 funds that hold it. So you could put like AT&T in and get a return of which ETFs are holding AT&T as like a top 10 or top 20 holding or something like that. I think there's a search function on the brokerages. Don't quote me, but look for it. I'm sure you could find that information online easily. There's a thing called Google that helps try to find information. And
or ChatGPT.
We've been playing with ChatGPT. We're gonna spring a little ChatGPT stuff, I think, here in the next week or two.
Man, if ChatGPT was around in school,
that'd be killer, right? But really, there's no reason to stress over it. There's no reason to be like, oh my gosh, I can't put money in the stock market. I'm gonna lose money, because you're losing money by not being in the stock market when inflation is as high as it is, and your money sitting in a savings account. Granted, it's going to earn a little bit more now because of inflation and the rates going up, but over the last 10 years, your money didn't make anything sitting in a savings account. And inflation, when running at 2, 3, 4, 5%, and your savings account returning 0.1, 0.2% interest, you lost so much money by being super conservative. Where you can continue that level of conservative behavior by going into VOO or VTI or something like that, and been just fine. So that's just a little bit of knowledge for you to go do some research on your own and find out. Prove me wrong. That'd be great, but I don't think I'm wrong.
No, and the thing is, you can put the amount that some people have. You can put the amount that I have in my savings account into like Bank of America, and you'll get paid more as a dividend investor than they pay you to hold your money as a person with a savings account. They pay the dividend investors more every quarter.
Man, I think I've got a Capital One 360 checking account that pays like 3%. I mean, come on, you can get that you don't got to search hard to find 3%, but a little extra work and you can get that, plus the underlying returns of a stock market on your money in an ETF. You can get 3% guaranteed, plus you can get that stock and the value as it goes from the $100 you bought in at to the $500 when you retire in 20 years, 30 years. I mean, you can't beat that. You're not going to get that anywhere else.
You can't. And at one go ahead.
No, you go ahead.
I was gonna say, like I always put on my paper, man. At one point, you're not gonna be able to outwork these dividends. You can outwork them now, but at one point, you're not gonna be able to outwork them.
No,
you just can't. The math is not gonna add up.
No.
Well, the math is gonna add up, but it's like you might as well. You're not gonna be able to outwork compounding interest.
No. We're at such a good time, like we talked about earlier, as far as where the market is. I think this is a great time to be able to start investing. We are also at a time where the stock market has been truly democratized. It has come down. Even when I started with Schwab, I was paying like $4 or $5 a trade. You know what I mean? Both sides of the trade, buy and sell. And now I don't think you can find a broker that charges you per trade. So it's truly to the point where anybody can benefit from the stock market. Anybody can benefit from this generator of wealth that in generations past was reserved for only those people with the money. So now we get to play in the game too.
It must be nice.
Right? And we're not doing millions and billions like the Rockefellers and all those people. But if we can make our little corner of the world a little bit better, then we need to take advantage of that. And the opportunity is there, and there really is no reason not to take advantage of it.
Nope, no excuse at all. As they say, what's your excuse?
You got none. Man, cool, dog. Thank you very much, man. I appreciate it. This was a good talk.
Of course. Yes, of course. And any viewers out there and listeners, if you guys have any questions on anything that we talked about, do not hesitate to shoot us a message on our email, Twitter, YouTube, on any platform. We will be happy to answer and be able to help you guys out on your journey to financial freedom.
Yep. Hit us up. Let us know if we're wrong someplace. We're more than happy to come up and correct ourselves.
Yes, please let us know we're wrong. Because I know we're gonna, it happens. We're humans, so it's like this is the fun part of investing. Always knowing,
and we're learning with everybody. We are not experts by any means. We learn. And then if we're wrong, we'll correct ourselves. We want to be right. So,
all right, guys. Well, you got it here. It got the dividend dog, options legacy, Paul. We are here on the Investing on a 9 to 5 podcast, rocking it out with you guys here on this Monday night. You guys have a good night. We'll see you on the next episode.
Bye.
We're out.